Stock markets have been seeing record highs recently. Now, will the rally continue, consolidate, or go for correction? To tell us about the markets ahead and also talk about his new fund launch, we are joined by founder of Abacus Investment Manager, Mr. Sunil Singhania. Thank you for joining us on Business Today, sir.
Pleasure.
Sir, I want to start by asking you that, when you talk about broader markets, where do you see globally the bubble forming? Is the US markets, Japan, or the others? And how does that change your market positioning currently?
So obviously, markets globally have been, very, very good in 25. And the countries you mentioned, whether it is Japan or China or in the US, particularly NASDAQ, Taiwan, some of these countries have done well. And largely because investor interest has been in some of these new tech companies, whether it is AI, whether it is data centers, semicon, and so on and so forth. Having said that, obviously markets are not as cheap as they were earlier, but the growth in some of these companies have also been great. And I would say to some extent, when returns are good, more money goes into the same companies. And that is the reason why we are seeing a little bit of increased volatility in some of the markets you mentioned. Our view is that from a one-horse pony where, all the money was going only in new age companies, I think the global investors have also started to diversify a little bit. And maybe the kind of outperformance with some of these companies and markets saw in 25, that might spread to the broader markets in 26. And in fact, that should be positive for India. Because Indian markets to some extent suffered because we did not have too many listed companies in this high-tech segments. And now as we broaden the horizon as far as investor base is concerned, I think Indian companies will also start to attract attention.
Your take on the valuations in the Indian markets and, what's your outlook on that?
So India has always traded at a premium to the emerging market and some of the peer group countries like China. Towards the end of 24, that valuation premium had shot up to 40% on PE basis. I think that has now come back down to around 14-15%, which is just slightly higher than the 10-year average. And India will always trade at a slight premium. One, it is democracy. Second, the demographics are in our favor. We are one of the youngest economies. Third is the growth rates are higher. The return on equity profile of Indian corporates is higher, and therefore India deserves to trade at slightly higher P. So I think at these levels, we are reasonably priced, and any long-term global investor also cannot afford not to have exposure to India.
Do you think we will continue to be the global hope trade, or the IPO-driven frenzy could, overheat the markets?
So in markets, all segments are important. And from time to time, there will be always some segments which will become cheap and some segments where there will be a little bit of, I would say, overvaluation. Maybe, to some extent, some IPOs are a little expensive, but at the same time, IPOs are necessary. See, this economy moved from 1 trillion to 4 trillion. Some sectors contributed. From 4 trillion to 8 trillion, when we move, there will be very different sectors which will contribute. Even if you see last 15, 20 years, IT services, pharma, hospitals, they were never there as key listed plays. Now, if you see, they are big components. And I think some of the new age companies which are getting listed will always have that moat, and some of them will really grow very, very big. So I think we will have to also look at IPOs because that will be the way of investing in some of the future companies, earning. At the same time, I do agree that some IPOs are priced a little bit expensive, and maybe some IPOs might not deserve to be even have a look at it. So I think it's an investor to do proper research and look at it. I think from a market perspective, there will always be these kind of things. So now the investor has to do what is within their philosophy and the risk-taking ability.
Your take on the FII flows, because now the rupee has weakened against the dollar. So what's your outlook that, what effect will it have on the FIIs and in general the over outlook on the FII flows?
So FI outflows have been very strong from India. Again, largely because one, India had become a little expensive compared to the world. I said almost 40% expensive. Second is foreigners wanted to move into these new age companies, and Indian equity, the secondary market or the listed space did not offer them those kind of companies. And therefore, FI flows moved to China, which was cheaper, as well as they had this high-tech companies and Korea and Taiwan and Japan and NASDAQ. I think to some extent that is now seeing slight reversal. So October we had positive FI flows. November was only mildly negative. So from a period where FI outflows were 1 lakh to 2 lakh crores a month, we have now come to a flattish kind of a scenario. We also run global mandates and we have a foreign fund. We are increasingly seeing now more interest coming in from foreigners. So I think it's a matter of time before positive flows from foreigners return to equity markets in India.
And do you see the weakening continue of the rupee, or you see, a pickup?
So I'm not an expert, frankly, on rupee, and I would say that long-term trajectory of rupee depreciation should be more like 1.5–2% a year rather than 3.5–4%, which was earlier the norm. Largely because the current account deficit has come off significantly. Even I think yesterday or today I read somewhere that current account deficit is just over 1%. There are a few things. One is this tariff obviously is impacting India, and we might say whatever, but I think we need to get a resolution to this tariff very quickly because our exports definitely got hurt in October. Second is this huge frenzy in gold and silver is leading to record imports of gold and silver, and I think that has led to trade deficit in October being at a record high. We are blessed that we have a very, very vibrant services economy, and therefore the net outflow, net of goods and services is not very significant. But I think if the tariff issue is sorted, you might start to see some semblance as far as rupee dollar rates are concerned.
As you just spoke about gold, do you think investors should continue to, what's your outlook on gold basically?
I'm always wrong on gold. So last year I was positive, but I never in my wildest dream thought that gold will give anything more than 20–25%.
The ETFs was also really surged.
So I have always gone wrong. So gold does very well when there is uncertainty. This time gold has done extra well because there's also uncertainty and lack of confidence on the US dollar. And obviously this whole tiff on tariff which President Trump and US is creating is also leading to less confidence in countries keeping all their reserves in dollar, and that's why most of the reserve banks and central banks in the world have diversified into some gold, and that is also creating near-term demand. But let's see, I'm not a big fan. The good thing is that Indians have always had gold, and as of today, it is said that Indians own almost $4 trillion worth of gold. So the wealth effect is huge. We have added almost $1.5 to $2 trillion in net wealth of Indians because of gold prices moving up. And if you just compare it with equity, you only have $1 trillion worth of equity. So I think the wealth effect is huge, and ultimately that will also help the economy.
Sectors you're bullish and you feel are overheated right now?
So I think we are positive on the financial services, not only on banks, both the banks, select PSUs, NBFCs, but also on non-fund based financials like capital market plays, wealth, asset management plays, insurance companies, and so on and so forth. I think niche manufacturing, particularly engineering, is something which we are positive. Obviously, this tariff thing has to be sorted because our companies do export to US. Incrementally more positive on the likes of pharma, some metals and chemicals. The good thing about India is that we are very diversified. So for us, it is more about stocks rather than, trying to be underweight, overweight sectors.
Talking about your first fund launch of your mutual fund company now, the FlexiCap fund, how is it different from all the other FlexiCap funds in the market? It's a very crowded space, and who are you targeting with this?
So one is, I don't believe it is crowded. So as an economy, we have like $500 billion of exposure to Indian equities through the mutual fund route. I think it is very, very low. It can be easily 5–10x of this over the next couple of decades. As far as the mutual fund industry is concerned, you do have 50 players, but if you actually see the top 25 players would be 90–95% of the market. So technically it's a 20–25 player market. From our FlexiCap perspective, it's the first fund. So hopefully, let's see. Our focus obviously is going to treat this FlexiCap as a FlexiCap fund. There are a lot of FlexiCap funds which are very, very significantly biased towards large cap, and they maintain that. So we view them as large cap 2 rather than FlexiCap. We believe that we will have a proper mix of some large cap, which will be 45–50% as of today, and some mid and small cap. We start with a small base, so that would be an advantage. I don't know whether it will be different or not. I think the whole objective would be that all our experience which we bring in to the table, as I said, youngest AMC with decades of experience, that is what we'll focus on. And we have a good team on the AMC side also now, and we do things on a very fundamental basis using our proprietary meets framework. And our objective would be to give consistent performance over a period of time. And if we are able to do that, and if our investors feel that we are adding value, then obviously, we also will be able to create a niche for ourselves.
What will be the strategy of your fund house? Because, as you said, there are 50 players. And what are your plans? Do you plan to launch other funds? And
So one is very clearly, we are only in asset management. We don't have any other business, so we are very, very focused. And we have only done asset management for decades. Obviously, we will have to launch a few other funds so that, we are able to cater to the requirements of the investor base, because there would be some investors who would be looking at small cap, some looking at balanced funds. So I think over the next 3-4 months, we will definitely launch another 2, 3, 4 funds. Going forward, obviously, SIF will become a very interesting opportunity. And, India is still just about touching the surface, as far as the economic growth as well as financial saving is concerned. So there's a lot of room for growth, a lot of room for innovation. And we will try to be relevant.
are your advice for the investors, like should they stay in cash, see a correction and then deploy, or, tilt towards large caps, or what's your outlook on that?
So we are incrementally quite optimistic of the Indian economy. I think with RBI also creating a lot of liquidity, pushing for growth, and government also giving a lot of tax benefits to spur growth, we are already seeing the impact of growth coming in. Hopefully this tariff thing will be behind us very soon, because there is no logic of India being at 50%, whereas most of the other countries are significantly below. And we are heading into a good season where, we have seen October, November growth rates being very decent. Monsoons have been good. Budget hopefully should be again a catalyst for further infusion of growth from the government side. We are heading into a good period. I think next 15-18 months for corporate profit should be good. And I think looking at all this, I would say that it is a good time to invest. Obviously, tariff thing we need to get resolved. And as you rightly said, there is a lot of paper supply, so that might cap the near-term upside, but we don't see any major correction.
What returns can the investors expect in FY26?
I don't know about
And
26,
earnings
but
that-
I think from a 3-5 years perspective, our view is that large cap earnings can be 10-12%, corporate India earnings can be 14-15%, and I think that kind of returns is what investors should expect.
Thank you so much for speaking to us, Sunil.
Thanks a lot, and thanks for your wishes for our mutual funds.
Thank you.
If you like the video, do like, comment, share and subscribe.